We will begin with the webinar now. We'll start with the sessions. So today's session and today's topic is majorly about tax filing and compliances as we have entered already, as we have completed the financial year 25-26 and we are about to file our returns and all. So at this point of time, we wanted to highlight and bring into your notice why is it important to file the income tax return within the due dates and what all things has to be taken care, as well as in the current year, that is the current tax year or 26-27, how you can plan your taxes ahead and also avoid certain interest penalties and save the taxes. So we'll just start with the session. In today's session, basically, we'll be first discussing about the ITR filing for the financial preceding financial year, that is 25-26. And then we'll look into the residential status, slab rates, and advanced tax compliances to be taken care by an individual. Then we'll look into the various heads of income that is there. Then we are also going to do a comparison between ROR, that is the various residential status that is applicable for an individual, that is ROR, RNOR, and non-resident. And finally, we will look into certain key points that has to be taken care by a returning NRI. So a person who was settled outside India, and if they decide to come back to settle down in India, what all things can be taken care by them. So these are the key points that we'll be discussing today. And finally, we'll be having a question and answer sessions as well. So if you have any questions, you can put it down into the chats. After the agenda points discussion, we'll be looking into all the questions and I will be answering those queries as well. So please consider this webinar only for an educational purpose and for general use. This should not be taken as a tax advice because depending upon the stay details as well as the sources of income and on the basis of various factors, the tax advice will vary. So please just consider this webinar to be for general use and for basic understanding. So first we'll look into the income tax return filing things. So the ITR filing for financial year 25-26, as I mentioned, we are already into the assessment year. So the preceding financial years, that is 25-26, tax filing has been started. Already the ITR 1, ITR 2, and ITR 4 is available in the IT portal, and we can proceed with the filings. So ITR 1, that is a basic, the most common and the basic form, which is applicable for salaried individuals and who is a resident individual with only salary and interest income. So those people can opt for ITR 1. ITR 2 is basically for non-residents, RNOs with global incomes, where the salary is exceeding 50 lakh rupees and all. So that is when ITR 2 is applicable. That form was released yesterday and it's available in the IT portal for IT means tax filing. So we'll just look into the ITR due dates. So this year there is a change. Usually the due date is like it was till now 31st of July. So for each financial year, due date for tax filing was 31st of July. This year there is a change where they have introduced if a person who is having a business or profession income, for them the due date applicable will be 31st of August. Uh, so everyone who is just having salary, interest, rental incomes, and there is no tax audit applicable, for them the due date remains the same, 31st of July. And the forms applicable will be ITR 1 and ITR 2. But an individual who is having business and profession income, for them, the due date is going to be 31st of August 2026. And the forms that will be applicable is ITR 3 and ITR 4. So when I refer to business profession income, this also includes speculation business or income from trading into futures and options or intraday. So all those incomes will also be treated as a business or professional income. Okay, so those incomes uh, will for them the people who are having that income, for them the due date is going to be 31st of August 2026. Other than that, the due date is going to be 31st of July 2026 unless Income Tax Department provides an extension. So currently the due date is 31st of July. If the department comes up with an extension, then the extended due date will be considered. And why it is important to file the income tax return. In certain cases, it is mandatory as well. It's not an option. So if suppose you are having, if there is a carry forward of losses from securities or let out house property, like you invested into securities, you made losses, and if you want to carry forward that losses, then definitely you must be filing your income tax return. These losses can be utilized in the subsequent year to set off with the profits or the gains. So in the subsequent year, if you are having a gain and if you want to set it off with the past year losses, you must definitely file your returns within the due date, and then only you will be eligible to carry forward the losses. So when I refer to losses here, it can be short-term capital loss, it can be long-term capital loss from securities, Indian securities, foreign securities. It can be speculation loss, that is a person who is trading into futures and options or doing intraday trading. If there's any losses booked from that as well, to carry forward that losses, return must be filed within the due date. Next is foreign asset disclosure, which means it is mandatory. If you are having any foreign asset, let it be even a savings bank account or a checking account outside India, you must file your income tax return and disclose that foreign asset, even though you're not having any income, even though your income is below the basic exemption limit as well. Still, it is mandatory to file your return just to disclose your foreign asset. So foreign asset, there's always this confusion, and also there are many clarifications given by the income tax department in the recent times, where they are specifying that if you're just having stock units of a foreign companies, that is also a foreign asset, and that must be disclosed in the ITR. So this is something that many people miss out, and we always wanted to highlight this, and the department is also bringing this into the notice, that if you're having stock units of a foreign listed company or a foreign unlisted company as well, then you must definitely file your return, disclose that stock units in the Schedule FA in your income tax return. Okay. The next point is like to claim income tax refund. If there is excess taxes withheld, suppose your income is less than 12 lakh rupees, but you had some interest income and already 10% taxes has been withheld on that. So to get a refund of the taxes withheld, you must file the return. You cannot go to the bank, you cannot go to the person who has withheld the taxes and ask for a refund. You must file your income tax return, and then only you will get the refund of the excess tax withheld. And this has to be done within the due date. So there is an option to file a belated return also, which we'll be discussing in the upcoming slides. But if the returns are filed within the timelines, then only you will be eligible to get a refund. Otherwise, after 1 year down the line, you will not have that option to file a return and claim refund as well. Um, Fourth point is to claim exemptions. So in case you have sold securities and if you want to claim exemptions by investing into residential house property, so there are various sections which provide exemption if you do the investment into another residential house property or purchase a new residential house property. So if you want to claim such exemptions, in that case also you must be filing your returns within the due date. Uh, and you must mandatorily file to get that exemption. Later, in case if the department select your file for scrutiny and later if you claim these exemptions, they will disallow it. So if you file the return within the due date, then only these exemptions will be available. Last point is like total income exceed basic exemption limit. So who is liable to file an ITR? This is always a question. Many people think that the income, they don't have any taxable income, so they are not liable to file the returns and all. But it's not that case. If your income is exceeding the basic exemption limit of INR 2.5 lakh, in that case you are liable to file your return. So 2.5 is the old regime limit. In the new regime, it is 4 lakh. So if your income is exceeding 4 lakh, then you're liable to file income tax return in India. We'll just go to the next slide. So the details what we discussed here, the due dates and the timelines, this was for the original return filing. So basically a return has been classified into four. First one is original return. That is if you file it within the timeline specified by the income tax department. Second is revised return. Third one is belated return, and the fourth one is updated return. So first we have discussed about the original return. Now we'll just look into the revised return and belated returns. As per the latest update, a revised return can be filed till 31st of March 2027. So all the numbers or the dates what I'm referring here is keeping in mind financial year 25-26. So if a person has filed already the return within the timelines, that is an original return has been filed, then they get an option to revise it as many times as they want. They can revise the return, and always the latest return or the revised return will be replaced with the original return. So no one is going to refer the original return and come back with any questions. If you have filed a revised return, the department will always look into your revised return and not the original return. So that's why a revised return, a person can revise the income tax return, original return file as many times as they want. There is no limitations that only once it can be revised or twice. As many times as they want, they can revise, and always it will replace the original return filed. And previously, the timeline to revise a return was 31st of December of the assessment year, but now it has been changed. It is 31st of March 2027. That is 1 year from the end of the financial year. You are getting time to revise the return file. Okay, so till 31st of March, you get an option to revise the return. Next is belated return. So in case you have missed the due dates mentioned in the previous slide, like by 31st of July, you don't file your income tax return, or by 31st of August, the returns are not filed, then a belated return can be filed. When you file a belated return, there will be a late filing fee which will be imposed, which can go from 5,000 to maximum from minimum 1,000 rupees to maximum 5,000 rupees, which means a person who is having just income less than 5 lakh rupees, to them 1,000 is the belated return filing fee applicable. But if it is more than 5 lakh, then 5,000 will be the belated return filing fee that is going to be applicable, which means you have missed these two due dates, that is 31st of July and 31st of August. And a belated return can be filed till 31st of December 2026. That is, if you miss 31st July deadline, you have still time to file the return as a belated return till 31st of December 2026. The consequences of filing a belated return is like all the previous, in the previous slide, whatever things we mentioned, that is carry forward of losses and certain other benefits that will not be available. So if you file a belated return, you cannot carry forward the losses, capital losses, speculation losses, and all. If there is any foreign tax credit, that is, you are a resident individual and you have global income, you have paid taxes in other country, and if you want to claim a credit of that in India, you can file the Form 67 and claim it, but it is subject to litigation. We cannot assure that definitely this credit will be allowed. Department might disallow it, and we will have to go into litigations and get in our favor. So that is a time consuming process. So a person who is having foreign tax credit, we always advise them to file the return within the timelines. Um, and if you want to opt for old regime, again, you must be filing your return within the due date. If you plan to file a belated return, you will not get an option to opt for old regime. Mandatorily, it will be a new regime which will be selected. And interest also, like if there's any balance taxes payable, there'll be further interest which will be getting added up. So previously, if you would have filed within the timelines, interest would have been calculated under 234B and C. But now, because you're filing a belated return, there'll be a new section added, and interest will be payable under that section as well. It will be around 1% of the tax payable amount. We'll just look into the next slide now. Hope this is clear. Next is about updated returns. So this is something which was introduced by the Indian government somewhere around under budget 2022, I believe. So what happened is like updated return is an option, like if already the timelines are over, you have missed to file your original return, you have not filed your revised belated return, and there are no other options available for you. Like the original and belated return is not possible to be filed after 31st of March 2027. Then finally the option available is to file an updated return. So when you file an updated return, there will be additional taxes which will be collected by the department. And also it has been put in such a way that only when there is a tax payable scenario, a person can file updated return, which means after 31st of March, if you want to claim a refund, as I mentioned previously, you cannot. Only if there is a tax payment for you, then only you can file an updated return. And the penalties will be like this. After 31st of March 2027, within 12 months, if you plan to file, 25% extra tax will be collected. So this 25% extra tax is on the balance tax plus interest amount of whatever is your total balance tax plus interest of on that 25% will be straightforward imposed, and that will be the additional tax that department will be collecting. Similarly, within 24 months, if you file, like you have missed the deadline of 31st of March 27, but you're filing it uh, in March 29, then 50% extra tax will be collected. So that's how when you file an updated return, there will be additional taxes that will be imposed. And an updated return can be filed only to make tax payments. You can never claim a tax refund, or you cannot reduce your tax liability as well. And if you have any losses, you cannot declare that, or you cannot carry forward a losses with an updated return. So this is all about updated returns. Next, we'll just look into the residential status, tax rates, and advanced taxes. So in India, the residential status of an individual is determined on the basis of number of days of stay in India in the current as well as the preceding financial years. There are basically three status. First one is ROR, that is resident and ordinarily resident. For this individual, the global incomes will be taxable. The next one is resident, not ordinarily resident, that is RNOR. Only the Indian incomes will be taxable for that individual. And this is also known as a transitional phase. Uh, and the final one is non-resident, where only the Indian incomes are taxable. So non-resident and RNOR status, it's almost similar where only the Indian incomes will be taxable. So for example, a person who was settled in the US, they plan to come back to India, and when he is coming back to India, like till 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 the current financial year, each financial year he has visited India only for suppose 30 days or a month's time. So in that case, he has hardly stayed in the preceding financial years in India, right? So each year he has stayed for 30 days. So the first year when he came to India, there is a possibility his status will be non-resident, and in the subsequent 2 years, the person will be RNOR. So during at least for 3 years, the person individual is getting a benefit where in India only the Indian income is going to be taxable. So that's the reason why this is called as a transitional phase, which means during this time frame where an individual's residential status is non-resident or RNOR, they can do all the tax plannings and plan to bring back the amounts from US to India or wherever they were residing previously from that country, whatever assets they have, they can plan to dissolve it and bring it back to India, and there won't be any tax implications in India. So that's why these two status is important when you plan to relocate to India. And under ROR status, the global incomes will be taxable. That is, whatever income you receive in India as well as outside India, all those incomes are going to be taxable in India. So that's how the ROR status will be. So in the upcoming slides, we have done a detailed comparison between how the what is the difference between under all the three status from the tax perspective, from the disclosure and compliance perspective. So in the upcoming slides, we'll be looking into it in more detail. So to derive at the residential status of an individual, as I mentioned, current year stay as well as the preceding few years stay details is considered, and then it is derived. So it's a very detailed computation. So first it says there are two basic conditions that has to be checked, which determines whether a person is resident or non-resident. And if a person is resident, then we need to look into two additional conditions to determine whether the individual is ROR or RNOR. Okay, so that's how it works. There will be two basic conditions checked. Either of the basic conditions satisfied, a person will be resident. Um or non-resident, the determination will happen. If a person is a resident as per the basic condition, then the two additional condition will be checked. And if both the additional conditions are satisfied, then only the person will become ROR, otherwise RNOR. So that's how the residential status check will be done. So this is here we are just looking into the slab rates under the new regime. So this is something there was no change in the latest budget as well. In the previous budget, whatever they announced, they continued with their same tax slabs under the new regime for the current financial year as well. So this is how the tax slabs are. So an individual whose income is exceeding 24 lakh, then the 30% slab is going to be applicable. Otherwise, it's just with each 4 lakh increase, 5%, 5%, the tax rate has been increased. So this is how the new regime tax slab looks like. And under new regime, the only benefit available is there's a standard deduction of 75,000 provided to salaried individuals. And apart from that, as salaried individual, if there's any employer contribution to national pension scheme, then that is allowed. So these are the only two deductions which is available for a salaried individual under new regime. If there is a let out property and if there is any interest on housing loan incurred on the let out property, then that is also allowed as a deduction. Then there'll be surcharge on top of this slab rates. There's also something called a surcharge, which is applicable when the income crosses the specified limits. And then plus there will also be health and education cess of 4%, which will be applicable. So we'll look into the surcharge rates in the upcoming slide. So this was all about new regime. Then coming to old regime, there is no change from past 3-4 years. The old regime rates have remains the same. The deductions and all continue to be there, but they have not reduced. So if you see here, about 10 lakh itself, the tax rate is going to be 30%, whereas in the new regime, it was about 24 lakh. So that itself is bringing a lot of difference. So an individual to opt for non old regime, that is to get benefit under old regime, at least 7.75 lakh of deduction should be there. That is HRA, ATC, all the deductions put together. If it is somewhere around 7,75,000, then we can say that person might get some benefit under old regime as compared to new regime. Otherwise, mostly the new regime is going to be beneficial. So all the deductions continue to be there under the old regime, that is Chapter 6A, HRA, LTA exemption, and interest on housing loan up to 2 lakh rupees on the self-occupied property. So all these exemptions are available under old regime. And if you make any donations to any uh, NGO, political parties and all, still you will get all those exemptions, okay, under old regime. So under new regime, even the donations are not covered. And in the recent budget, there was also certain changes where they mentioned children education allowance and also about hostel allowance, meal allowance. So there were various allowances where the limits were increased. So to get benefit of all those allowances under old regime, you must have that as a salary component. So in your salary structure, you must have that component as children education allowance provided to you. Then you can provide the bills and claim those exemptions. Otherwise, just with the bills, you cannot claim that allowance as a component. It should be there in your salary structure, then only those exemptions can be claimed. So this is about the old regime. Here, I've just taken a hypothetical number to just show how the taxes are computed. So the gross tax, suppose your gross tax is 1 lakh rupees. Okay, so this 1 lakh rupees is on the basis of your slab rate. The gross tax is 1 lakh. A surcharge of 10% is applicable if the total income exceeds 50 lakh rupees. So 10% will be applied on this gross tax of 1 lakh. Okay, so it will come to 1 lakh 10,000. And on this 1 lakh 10,000 and health and education cess of 4% will be applied, which will come to 4,400 rupees. And that's how the total tax will be derived, and it is coming to around 1,14,400 rupees. So this is how the computation is done. The final tax amount is derived. So surcharge is not something which is applied on the income directly. It is something which is imposed on the taxes, and health and education cess is applied on the gross tax plus surcharge amount. So I've just taken hypothetical number. It's not going to be 1 lakh here. So this is just as an example. Please consider it. like that. Now, next is about the advanced taxes. So this is something like among the individuals, there's always an assumption that advanced taxes are applicable only when there is a business or profession income, or a person who is a salaried individual. They also think that advanced taxes are not payable because TDS has been deducted by the employer. So yes, towards your salary income, always the TDS will be withheld by the employer, because if they don't do it, they will have to pay the penalty. So that's the reason why always for the salaried individual, whatever taxes has to be collected, it is always taken care by the employer, and after TDS only you receive the net salary in hand. But at the same time, an individual, if they have other heads of income, that is rental income, interest income, capital gain on securities, so these things, these vendors or the prospective people, it's not mandatory for them to withhold the taxes, right? There's no tax audit applicable for a salaried individual. So there's no compliance required by the other party to withhold all these taxes when they're making the payment to you. So that's why advanced taxes are payable by an individual if they have other heads of income apart from salary. Like if you have rental income, and even though on the rental income there are certain cases where TDS is withheld by the tenant and deposited, but it's a very minimal amount. They withhold only 2% of the total rent. Whereas if you're falling under the 30% slab, there's going to be a huge difference. So whatever is the balance taxes, it should be paid out of your own pocket by doing a self-assessment of the taxes payable. So that's when the advanced tax become important. So advanced tax is payable by all the individuals if their tax liability during an year exceed 10,000. So when I say 10,000, this is after TDS, TCS, foreign tax credit and all. So if suppose your total taxes payable is 1 lakh in a year, already TDS of 50,000 has been withheld and foreign tax credit of 20,000 has been withheld, then the balance taxes payable is 30,000, which is exceeding this limit specified, that is 10,000 limit. So still you're liable to pay advance tax. And if you don't make the advance tax payment, interest will be imposed by the department under two sections, that is 234B and 234C. Only for a senior citizen, a person who is a resident individual and a senior citizen, advanced taxes are not applicable. And the person should not be having any business profession income. If we have all the other heads of income, it's fine. So if a person who is having business profession income, mandatory advanced tax is applicable. A person who is a resident individual but not a senior citizen, again mandatory advanced tax is applicable. So only condition is a person is a senior citizen, resident, and without business profession income. That's an exceptional case where advanced tax will not be applicable. For all the other individual, advanced taxes are applicable. The due date of advance tax looks like this. It is the dates are fixed by 15th of June, 15% must be paid. 15th of September, 45% of the advance tax should be paid. 15th of December, 75% should be discharged, and by 15th of March, 100%. So there are totally four installments of advance tax, and the taxes should be paid within these due dates to get the benefit and to avoid the interest. So here just an example has been given, like if it is 1 lakh tax payable after TDS and foreign tax credit in a year, it should be paid in this proportion, that is 15,000. So in the second installment, at least 45,000 must have been paid. That is already 15 if you have paid in quarter one, then the balance 30,000 should be paid in the quarter two. So that differential amount has to be discharged. And also on dividend and capital gain, advance taxes are payable only on actual receipt basis. That is when you receive the dividend or when you realize capital gain, then only advance taxes are payable. You need not forecast those incomes. Here, these are the two sections under which interest will be imposed on non-payment of advance tax. So the interest rate is around 1% per month. First section says at least 90% should be paid by way of advance tax. And the second section says if you don't pay the advance tax in the installments mentioned, then there will be interest imposed. So both the things has to be taken care. Then we'll just have a quick look into the various heads of income. I'll just cover these slides quickly. So there are totally four heads of income: salary, rental, capital gain, and income from other sources. Business profession is also there, which I'm not covering here because most of our clients are salaried individuals and who have these incomes and not business profession income. So when it comes to salary, you have to refer your Form 16, or the other key document is March month tax statement. So that is March 2026 tax statement will have a detailed breakup of your entire financial year's salary structure, taxes withheld, net amount paid. So that is more beneficial than a Form 16. So if you provide us the March month tax statement, it is very easy for us to proceed instead of waiting for your Form 16. uh, as usually the Form 16s will get delayed. The due date for the employer to issue is in first week of June. So they will take their own time to issue these. But you can do your tax planning well ahead with the help of your March month payslip and detailed tax statement. Okay. Then apart from that, as for salaried individual, there will also be EPFO interest, which is going to be taxable. So there is, if an individual contributes more than 2.5 lakh in a financial year, that is employees contribution exceed 2.5 lakh, the excess amount contributed on that whatever interest is received, it is taxable. So when you download your PF passbook, you can get this breakup. As of now, EPFO has not issued or credited the interest amount for financial year 25-26. So the interest is still not updated in your PF passbook. But before filing of your returns, we need to verify this. And if there is any taxable interest, that should be offered to taxes. So this is expected somewhere by June or July that EPFO is going to credit the interest of the previous financial year. So this is a key document. Next is rental income. An individual with rental income, the only deductions available towards the rental income is municipal taxes paid during the year. Then there is a flat 30% standard deduction given, that is for repairs and maintenance. So a person who has rental income, flat 30% deduction will be provided irrespective of the actual expense. Even if you incur more or less than that 30%, still 30% is the only deduction which is going to be provided. And any interest on housing loan is also allowed, and pre-construction period interest, if any, that is also eligible to be claimed. So this was about rental income. Next is capital gains. So in the previous year budget, they have just simplified everything. The capital gains, the taxability, there's a one single rate which is applicable. So if you redeem equity oriented shares or mutual funds, and the tax rate is going to be 12.5% for long term capital gain and 20% for short term capital gain. Here the holding period should be 12 months. This is available only for Indian listed equity shares and mutual funds, the holding period of 12 months. Okay. if the if you invest in any other asset class, it can be immobile properties, unlisted securities, foreign securities. The holding period criteria is 24 months. When I say holding period, it is to determine whether the gain is long-term capital gain or short-term capital gain. Okay. So for equity shares and equity-oriented mutual fund, 12 months is the criteria to classify as long term and short term. For all the other asset classes, it is 24 months. And the tax rate applicable on long term capital gain is same, that is 12.5%. And for short term capital gain, it is slab rate. This is with regards to any other capital asset. For equity shares, it is 20%. Then there is some exemptions given for capital gains. That is, if a person is selling a residential house property and buying another residential house property, you have an option to get exemption of the taxes that is applicable on the capital gain. So similarly, if you sell a house property and invest into bonds, you get another exemption. And if you sell any other assets, like apart from residential house property, if you sell any other capital asset and invest that consideration into a residential house property, you get tax exemptions. Okay, so these are the three sections which provide capital gain exemption if the investment is done and the conditions are satisfied. income from other sources, this will have all the interest, dividend incomes and all. These incomes will be income from other sources are usually taxed at slab rate. And if there's any joint investments done, always the incomes will be reflecting in the first holder's PAN. So if suppose there is a joint FD, whatever interest is earned on the joint FD, it will be always taxable for the first holder. So you can do some tax planning over here and make the investment towards the person who is who is being taxed at a lower tax slab. Okay, so this is something that can be planned when you're doing the joint investments. Now here we are doing a comparison between ROR, RNOR and non-residents. So depending upon the residential status of a person, the tax rates applicable, the compliances applicable will be varying. So first we'll look into, so I have classified like the conditions or the uh, details what we are looking into. So first column basically tells about how that income is going to be taxable for the individual with the respective residential status. Okay. So scope of taxable income. So for RORs, global income is going to be taxable. For RNOR, only the Indian income will be taxable. So a person who is RNOR, only Indian incomes are taxable. Same goes with non-resident as well. Only the Indian sourced incomes are going to be taxable for them. Then foreign income. For ROR, the foreign income is going to be taxable. RNOR, not taxable unless linked to business or profession controlled in India. So for RNOR, it will be taxable only if the business or profession is controlled in India. Otherwise, it's not going to be taxable. And for non-residents, it's not taxable. Foreign asset disclosure, it is mandatory for RORs, and a person who is RNOR or non-resident, it is not required to be given. The foreign asset disclosure is not required at all for RNOR and non-resident. Asset and liability schedule, it's mandatory if the total income exceed INR 1 crore. So if an individual's income is exceeding 1 crore, that is a person who is an ROR, and the income is exceeding 1 crore rupees, then Indian as well as foreign asset must be disclosed under the asset and liability schedule of the ITR. For RNOR and non-resident individual, they need to disclose only the Indian asset. So if the income is exceeding, the total income is exceeding 1 crore, only the Indian assets has to be disclosed in the asset and liability schedule. Next is rebate under section 87. This is very important. So as you know, like for RORs, if the income is up to 12 lakh rupees, that which means a person who is a resident individual in India, and if the income is up to 12 lakh overall, then there is no taxes payable. But at the same time, if the person is a non-resident, for them this rebate or condition is not applicable at all. That is, if their income is for them, the rebate under section 87A will not at all be applicable, which means even though their income is less than 12 lakh, they are liable to pay taxes as per the slab rate. So this deduction or tax deduction will not be available for non-resident. This is available only for RORs and RNORs. Coming to dividends, for an resident individual, dividend is taxable at slab rate. For a person who is RNOR, for them as well, it's taxable at slab rate. But for non-resident, dividend is always taxed at a flat rate of 20%. So this slab rate is not going to be applicable for a non-resident. Then advanced tax for senior citizen, this is something we discussed. So for ROR, if the person is a senior citizen without business profession income, advanced taxes are not applicable. Same goes with RNOR status as well. But if a person is non-resident, it's always applicable irrespective of the age. And the TDS rates are also very low when it comes to ROR and RNOR. It's just around 10% or 2% TDS rate, which is applicable for these two residential status. But for a non-resident, it always the highest rate. So these are the key differences between the three residential statuses and how the incomes and other compliances are applicable for them. Now, certain things which has to be taken care by a returning NRIs. So when you are coming back to India, you must be very clear about what your residential status going to be in both the countries where you were staying till now and in India for the upcoming 3 years. So this will help you to do some tax planning. Um you must be taking benefit of your RNOR status. So with a proper tax planning, you can take the most benefit during the RNOR status, which is a transitional phase, and avoid double taxation. During this time frame, that is when you're returning and the upcoming 2 or 3 years, during that time frame, you must decide whether you are willing to continue your assets in the foreign country or you want to dissolve them and bring the amount back to India. Also, to what proportion you want to retain outside India. So these decisions, everything should be taken during this phase to get a tax benefit. So when you're leaving the current country, suppose an individual who is in US, before they leave, they should ensure that they have updated or they are having access to all their investments and all, because once you move out of the country, it's not easy to get access to all these assets. So better to have all the planning before you leave the country. And conversion of NRO and NRE account to a normal savings account. So once you move back to India, as per the FEMA regulations, if you are planning to continue your stay in India within 2 years timeline, you must convert your NRO and your NRE bank accounts and FDs into a normal savings account. So this is mandatory as per the FEMA regulations. So this is something which has to be taken care once you move out, once you come back to India. Now there are certain additional forms which has to be filed. So a resident individual to get the benefit under double taxation avoidance agreement to get the credit of the taxes paid outside India, a form 67 must be filed before filing of the ITR and within the due date. So the form 67 calculates the taxes paid outside India along with all the supporting documents. So when we file this form 67, we have to attach all the supporting documents like tax paid challan, or if it is US, it is 1042S form, or if there's any self-assessment tax paid, those challans. All those has to be validated, verified, along with the proper workings. It has to be uploaded while filing the Form 67. So this is one additional form that is applicable for a resident individual to get benefit of the taxes paid outside India. And next one is holding a 401k account. So 401k or Roth or IRA account, these are retirement accounts which is there in the United States. So many people who come back to India, they continue with all these accounts in the US. So for these accounts to get the tax benefit or to defer the taxes applicable on the incomes earned in these accounts, Form 10EE has to be filed. Currently, Form 10EE is applicable for the retirement accounts held in US, Canada, and UK. So again, this form is something applicable for a resident individual with retirement accounts. So this is also to be filed for them. Now, the further action points are like we can assist you with offering tax filing services. So, as an ongoing service, we offer advisory towards the tax exemptions, and we provide advanced tax computations and also ITR filing services. So, if you need our assistance in any of these services, you can always approach us and we'll be able to help you out. And as a part of advisory services, we provide 401k advice, capital gain exemption advisory services, and for returning NRIs, we do strategic tax planning during the RNOR phase. So these are the advisory services that we offer. We can also support you by analyzing the previous year's ITR and guiding you further, like whether any revision or filing of an updated return is required or any correction or rectification is required. And in case there is any notices received, we can also support and assist you further in that. So these are certain services that we provide to our clients. So if you are looking forward for anything, you can always write to us. Here is the email IDs to which you can write. You can take a screenshot. And we have another 10 minutes. So I would like